An unsecured long-term debt security issued by a corporation is known as A, a debenture, B, a mortgage bond, C, collateral trust bond, D, equipment trust certificate. A, debenture, issued with no specific asset pledged in security for the loan. When a U.S. resident investor purchases foreign bonds, depreciation of the bonds and depreciation of the foreign currency benefit the domestic investor. Appreciation of the bonds and depreciation of the foreign currency benefit the domestic investor. Appreciation of both the bonds and the foreign currency benefits the domestic investor. Depreciation of both the bonds and the foreign currency benefits the domestic investor. So obviously appreciation of the bonds is going to help it, but the answer is C, appreciation of the bonds and the foreign currency. And it says down here, and in the same manner, purchasing foreign equities adds diversification. Foreign bonds does that. Appreciation helps currency risk. It's denominated in local currency. An increase in the currency's value against the dollar means the semi-annual interest payments are be more valuable. So it helps both the bond and the foreign currency going up, helps the investor. Assume the corporation issued a 5% AA, AAA rated debenture at par. 2 years later, similarly rated debt issues are being offered at a little bit higher interest rate. What are the following statements regarding the 5% debenture true? The current yield will be higher than 5%. The current yield will be lower than 5%. The dollar price per bond will be higher than par. The dollar price per bond will be lower than par. And it looks like the answer is 1 and 4. The current yield will be higher than 5%, and the price per bond will be lower than par because the interest rate has gone up. Let's read the explanation. The bond's price will be discounted from rates going up. Accordingly, discounting of the issue will make the 5% debenture competitive with new issues offered with the 5.5%. So the bond's price will be discounted, resulting in a higher current yield. And current yield is annual income divided by current market price. You have the same annual income, but you'll have a lower market price, so the current yield will go up. Which type of risk is a mortgage-backed security most likely to experience? Business, reinvestment, market, or exchange? Answer is B, reinvestment. Mortgages are paid off early, and so you may not be able to find the same rate of return if your mortgage-backed investment happens to get paid off early. So B, reinvestment risk. Your customer owns 1,000 shares of XYZ 5.5% callable convertible preferred stock. It's convertible into 4 shares of common stock at $25. What should she be advised to do if board of directors were to call it at 106 when the common stock is trading at $25.50? So the price is up a little bit. They've called it. So the options are A, place irrevocable instructions to convert the preferred stock into common stock and sell short the common stock immediately. B, present the preferred stock for call because the call price is $4 above the parity price. C, convert her preferred stock into common stock because it's selling above parity. Or D, hold the preferred stock to continue 5.5% yield. The answer is B, present the preferred stock for call because the call price is $4 above the parity price.